everyone, and welcome to this week's On the Spot, where we discuss what's happening in the freight market, specifically around the spot market activity in the week. So I'm here with guest host Kevin Hill, which many of you are probably familiar with.
Good to be on the spot this week, Zach, filling in for JP Hampstead.
JP decided to take a day off.
I know, there's a holiday coming up or something.
Something about Memorial Day.
Yes.
But yeah, we have had a pretty interesting week this week in the freight market, as usual, especially during this COVID-19 outbreak. Nothing seems to follow the patterns that we've, been accustomed to seeing throughout the year. So, we are about to hit Memorial Day, Kevin, and that typically means that there is this delusion of capacity. It just goes away because everybody's taking vacations, time off, etc. We are seeing some tightness show up intermittently throughout the market. Now, I say tightness as a relative term, of course, but it's not really materializing like it has in years past.
Yeah, it's a very loose capacity market. I mean, the tightness in certain areas might, on the national level, over 3%. Or maybe hitting 4% is tightness right now, right around 4%. In certain markets will be tight. Drivers will be taking a vacation, the operations will be down a little bit. But relative to last year, certainly 2018, 2017, it's just a very loose market for trucking right now.
Yeah. Yeah, and last year, of course, was not a great year in terms of tightness in inflation rates right around Memorial Day. We were almost in this mini little recession in the middle of May.
Yeah, that's another strange thing about it, because last May, volumes are down 5-6% year over year, so the comparables should be easy comparables, and they are easy comparables, and we are maybe 4 or 5%. I know yesterday we were about 5%.
We're still underneath on the tender rejection rate. We're still underneath where we were. Now our volumes are actually better.
Yes, the volumes are better
year over year. So it took Road Check Week to really have a noted impact to supply last year.
It did,
which of course has been postponed this year. They're not going to do that anymore, so don't count on that in the first week of June traditionally. So yeah, we are seeing some tightness show up. It's again relative to what it was at the middle of April, early May, one of the loosest freight markets in history. Volumes have recovered to an extent. Now, these volumes aren't really putting that much pressure on capacity, not to the way that we would expect it to.
We would expect it to put quite a bit of pressure on capacity, even the April run-up that we had, late March run-up.
Yeah.
Didn't put as much pressure on capacity as you would think, with freight volumes up 30% year over year, or 29% year over year. You'd think there'd be a lot of pressure, and there was pressure, but not as much as you would have thought.
Right, and we think a lot of that has a lot to do with the fact that it's, we've got this uneven recovery, if you want to call it a recovery at this point. Certain industries are turning back on, or starting to turn back on. The automotive sector has decided that it's going to slowly ramp back up its production, which has not necessarily materialized yet. It's going to be a very slow cranking of that engine, it appears, at least in the automotive sector. Again, demand not very high.
Yeah, demand for autos is not very high. They have the inventory from the last 8 weeks to sell off as well. So it's going to be a very slow recovery, and probably very W-ish.
Yeah, very W-ish. I think about it more like a rolling wave.
Yeah, or a wave.
Rolling wave. Consumer sentiment, though, has started to come back up.
It started to come back up, and if you go to the uneven recovery, we, in Freight Intel Group and Passport Research, we did a study on credit card spending from Bank of America data, and correlated with the OTVI, and there was not too much of a correlation except for grocery.
Yeah.
Grocery had about a 0.75 correlation with a week lag, right? So if you lag that out a week, you have a very good correlation, and that's where most of the spending is right now in the economy, based specifically on that credit card and debit card real-time spending. E-commerce is big. Electronics, we're talking about that.
Actually showing up as a positive year-over-year comp.
Yeah, very positive year-over-year comp. So's home improvement.
Yeah.
You know, it's still about a 24% year-over-year comparable higher, where everything else is, besides electronics and e-commerce, is trending 30-40% lower. In some cases, travel is trending 99% lower.
Right.
So.
Yeah, no, and I think that's going to be the story of the next couple of months. We're going to see certain sectors boom, other sectors bust. We've gone over the fact that capital expenditures are not going to be a driving force in the economy this year. Budgets are slashed on that regard now. But again, you're talking about home improvement, you're talking about food and grocery doing well. You know, this mix is so hard to manage, especially on the freight market side. Like if you flood to one sector, you're abandoning another. That's going to create a lot of tightness intermittently in certain pockets. Los Angeles being one of those pockets of tightness right now. Anecdotally, it's one of the only markets that I've heard that people have really had trouble getting capacity, at least in any real level. I mean, there's obviously going to be little spots of tightness all throughout the United States at any given time. But Los Angeles continues to be, or the Southern California markets continue to be one of the tightest and fastest growing markets in the United States. How much of that do you think is due to, imports, maybe a secondary pull forward as we're hitting these service lags and all this kind of stuff? Yeah,
I think it has a lot to do with a secondary pull forward and kind of the inventory that was built up when China shut down and everything's sitting on the dock. Right. You had to clear all that out, and then you have this secondary pull forward, and we have an article on American Shipper from earlier this week from one of our contributors, Lorianne LaRocca, has a great graph in there showing this wave of imports coming in, right, and also talking about consumer demand, because if you go back to Bank of America credit card information, department stores, discretionary items other than home improvement, other discretionary items, spending's down 40%, 50%. Department stores somewhere between 40 and 50% the last few weeks. Right. It's kind of ebbed and flowed between there, and those are huge Chinese importers, right? Clothing or Southeast Asia, and they have been canceling their orders for the summer and fall at probably a record pace, right, or delaying or shrinking their orders. So that port volume is likely to come down,
and we're already seeing
quite a bit. Yeah,
we're already seeing it come down quite a bit. It's dropped significantly week over week, and it's been trending down since the end of April, early May. So it's inevitable that may materialize in the United States at some point. But how much of the freight movement in the United States right now do you think has to do with some sort of demand side, or is it simply a lot of repositioning?
On the freight demand?
On the domestic side, like in the United States. I mean, we see these intra-warehouse movements, et cetera, versus like this warehouse to store. So there's going to be potentially some level of disconnect between that credit card data and the consumer demand and freight patterns in the United States. Do you think that's accurate?
I think that is accurate. I think you're going to find inventories rising pretty rapidly, especially for individual companies that might not have the capital to absorb having cash tied into inventories. But you're seeing a lot of inventory repositioning, trying to figure out what to do with this merchandise that isn't being sold through right now. And I think you guys see it quite a bit. We see it in Sonar, right? Yeah, and you look at it quite a bit, is that between the long haul, the medium haul, and the short haul, and how that ebbs and flows and tells that story.
Yeah, I mean, how do you think a broker manages this environment right now? I mean, you can't rely on your transactional day-to-day ad hoc activity like you did before. A lot of people have flocked. Echo Global is now 60% contract or managed transportation, however you want to call it. And what does that world look like as a broker? I mean, you're sitting there and you've been living in the spot market for a little while. Now you've got some accounts to manage. Like what? How do you navigate? What do you need to do when you walk into the office every day, or call up, log into the office, I should say.
Yeah, log into the office right now. I think over the next 2 or 3 weeks, the most brokerages will be back in the office, and that's kind of our put the coffee down, put that coffee down survey showed us. But in a broker's world right now, it's a tough life. Yeah. It's a very tough life because you don't have any pricing power to the shippers. You're getting accused, sometimes rightfully so, driving rates down. You're not driving rates down. The market is driving rates down.
Sure.
I mean,
supply demand.
Supply and demand. When
the carriers, I always used to say this as a pricing guy for a carrier. I'm like, it's our job to price things. Like, if we're willing to move things at a loss, that's our decision. Nobody's forcing us to do it.
Yeah. You have the double-edged sword on that too, right? Because freight brokerage is very fragmented. Same, freight brokerage and carriers are the same type of industry. It's very fragmented, ran by a lot of smaller operators, right? And they're the freight broker is going to the shipper, trying to get loads, and they're getting underbid by other freight brokers who are in the same position, then they turn around and sell those loads into the capacity, and the carriers are doing the same things to each other, right?
It's the same thing.
So that really has a lot to say about the price action going down. Not so much going up, but going down. It's just a really tough market. Your customers, your shippers are trying to get the best rate because the demand for their products, especially if you're in industrials, is plummeting.
Yeah. Right?
They're just lucky to make a sell in a lot of cases, right? You think about oil field. Oil field's a disaster right now. So they're looking to cut costs. They're laying people off probably. They're furloughing people. They are delaying capital expenditures, right? Anything to save a dime, they have to do right now, and oftentimes that comes straight to transportation because it's seen as a commodity. Yeah.
Yeah, and of course again, those are the sectors that are depressed right now, not active. That's going to drive down the rates on those. So I think we're going to see some sort of alignment with commodity and pricing. Just like the financial markets, which is something that a lot of people aren't that familiar with in the transportation space. You can actually see kind of a clear line of sight between the commodity and the cost.
You can,
the demand.
yes.
I mean, it's almost like trading stocks or equities at this point.
It is. If you go back to the grocery, consumables, essential consumables, the capacity's much tighter in that, and you have more pricing power, and if you're in the contract side of the business, you're getting the volumes.
Right.
Now, those are probably going to get rebid down at some point, but not yet.
A lot of the contracts come due, in the fall, late in the winter when things are a little bit slower, so it will be an interesting bid season to say the least. But in the meantime, some of these commodities, some of these sectors, I mean, speaking of commodities and sectors that are starting to pick up, produce season has arrived.
Yes.
We're monitoring the California movements. Florida actually has got some tightness showing up in it as well, with strawberry season in California, lettuce, of course, the big lettuce produce harvest kicking off right now, and it is starting to show up. So it's occurring at the same time that it happens every year. What
about
Reefer.
this? I have a question for you.
Okay.
I have a question for you. So, do you anticipate some of these dry van carriers, maybe the really smaller fleets, the owner-operators, dry van, maybe flatbed guys, if they can get their hands on a Reefer trailer, do you think they switch out, and what does that do?
If they can get their hands on a Reefer trailer. I mean, the real capacity constraint for Reefer is the Reefer trailer. Drivers can drive Reefer and dry van. Not any different. As long as that temperature remains regulated in the back, they can drive it. So I don't see that being a real thing. In terms of loosening capacity, I think a lot of people have already kind of crawled into that sector that wanted to go. It's a very volatile life, though, living that Reefer life, because you go into one market to pick up, and you can charge, a premium to get out of California right now, but you're going to pay for it coming back in.
You are, yeah. You're going to become, whatever you can get, you're probably really become a dry van carrier.
Yeah,
going back in,
you're
right? You see a lot of guys doing that.
Well, Kevin, thanks so much for filling in for John Paul this week, and hopefully he has a great vacation, and you know, hopefully everybody out there has a great Memorial Day weekend. Get refreshed and ready to go. We'll see how this peak season materializes in June moving forward, and be sure to stay tuned to FreightWaves.com for any further freight market updates.